Hey guys, Dave Keller here with Market Misbehavior. Today we're going to talk about a potential mean reversion move in the energy sector. We'll look at an ETF tracking some energy stocks, also two individual names potentially rotating higher. We'll break down the charts, what they're showing now, and what they would need to show to turn more bullish. So 2023 has been all about two sectors, technology and communication services. If you look at the relative performance of those two sectors and all the other sectors, it's not even close. Tech and communication services have had incredibly strong years through the first 5 months of 2023. Other sectors have been struggling, particularly energy, materials, defensive sectors like utilities have really been struggling on a relative basis. What's interesting is as a sector like energy starts to go lower, at some point we have to hit the end of the trend, right? Unless the energy sector is going away, which it's certainly not doing today, at some point we start to see what's called a mean reversion, where we've gone so far down that all of a sudden we start to see buyers come in, and value investors are pretty compelled by the valuations that have gotten cheaper and cheaper, and they see it as a good opportunity. But what, from a technical perspective, can help us make that determination? We're going to look at the chart of an ETF called OIH, which is an Oil Services ETF, and we'll look at two stocks that are held within that ETF and look at some of the patterns, particularly a bullish momentum divergence. It has me thinking we might be nearing sort of the exhaustion point in their downtrend. Before we get to those charts, by the way, if you like this sort of thinking about technical analysis, behavioral finance, and investor psychology, go ahead and subscribe to my channel. Also, give the video a like if you appreciate it. We very much appreciate that back. Put a comment below, bullish or bearish on energy stocks here, and why. Let me know in the comments. Now, we're looking at a chart of the OIH, and the OIH is an Oil Services ETF from Van Eck. There are a number of different ETFs out there like XLE and others. I like to use a number of different ones, XLE, the OIH, the XOP. All of them have sort of different constructions, and I'll do more videos talking about the construction of these ETFs, the weightings, for example. OIH is an interesting one because right now it's showing a potential bullish momentum divergence. And what that means is as a trend goes lower, eventually the momentum, the negative momentum pushing prices lower starts to wane. And that's where you get lower prices but sloping higher momentum. Looking at a chart of the OIH, we'll get to the Fibonacci Retracements here in a little bit, but look at how the market or the price has rallied off of a double bottom in July in September of last year, retesting the highs from 2022 here in October and then November, and then breaking out in January. And in January of 2023, Oil Services are actually looking fairly attractive, right? Starting the year off strong, as many of other stocks did as well. Relative strength at or near highs, and overall showing some potential strength. Here, however, we had the dreaded bearish momentum divergence, which is prices going higher from November through January, but look at the momentum actually sloping lower. Overbought on the November high, not overbought on the January high. That is sort of what's called a bearish momentum divergence, where price is going higher, but the momentum is actually less positive over that time frame. Often happens at a significant market top. Fast forward to where we are at here, March, April, May, and now June, and you can see that we've made lower lows in price, but higher lows in momentum. Again, at the March low, when we tested 250 on the OIH, the RSI was oversold, meaning it's gone too low too quickly. We had a brief bounce higher. Then we retested the low again here in 250 a couple times in May. Look at how the momentum is actually sloping higher. It's not becoming oversold on these tests of that same level. This implies a potential exhaustion of sellers or willingness of buyers to come in and take a shot at the stock at 250. So that bullish momentum divergence sort of had me thinking. I then applied a Fibonacci analysis. This is a common way of just thinking once a market has had a move, once any sort of price behavior has had some sort of move, and then we retrace within those extremes, what levels might we expect support and resistance. What I did here was I took the low from September of last year and the high from January of this year. I then applied the Fibonacci analysis between those two extremes. 61.8% and 38.2% are the key levels, and these are sort of mirror images of each other. So 38.2% of the way down is about 283. 61.8% of the way down is around 250. Interesting that it's right almost exactly at a big round number there. Note how the March low, almost to the penny, hit that $250 level, that Fibonacci level. So what's interesting is it's a big round number, but also the fact that it hit a Fibonacci level as well. So these subsequent tests are not just testing the March lows, but they're also bouncing off of this 61.8% retracement over the overall vertical range. So we may expect support there just by the fact that it's at a key Fibonacci level. Now that the support is established, we've now seen that a number of times buyers are willing to come in. This bullish momentum divergence may be telling us about that willingness of buyers to come in and that we're at a potential bottoming phase. Now, on a chart like this, that's sort of a leading indicator. Right? This tells me a bottom may be here or happening very soon. What would help us confirm that the bottom is in and that oil services stocks are really starting to improve? Well, let's start from the top of the chart and go down. At the very top, we have the price below two moving averages, right below a downward sloping 50-day moving average. You can see in mid-May, we tested the 50-day and failed. We would need to test the 50-day moving average and break through it, which means the price needs to get at least above 270 to really complete that pattern. Getting above the 200-day moving average would be even better, and that's almost to 280. Second thing is we would have to stop making lower lows and start making a higher low. And this is what Charles Dow many years ago first sort of described as the basics of trend following, right? How do you define a trend? An uptrend is a pattern of higher highs and higher lows. A downtrend is a pattern of lower lows and lower highs. So if you think about what would confirm that a trend is no longer down and not starting to go up, we would have to stop making lower lows and start making a higher low. So putting in a low above 250 might be really interesting. So think about that's a potential trajectory of a break above the 50-day, a pullback that does not get all the way down to 250, and that might confirm that rotation higher. So far, the RSI is just not going down anymore, right? It's sloping higher as the price has gone down a bit and really essentially remains stable. Let's see if the RSI can get above 50, ideally even above 60, which would be more of a rotation to a classic bullish phase. In a bullish trend, the RSI rarely gets below 40 and often gets above 70 on rally phases. Let's see if the RSI can improve and start to be in a more bullish range. And certainly getting above 50 would be the beginning of that pattern emerging. The relative strength, looking at the relative performance of oil services versus the S&P, has been in a downtrend for the last 3 months. Let's see if this can rotate higher. So what's interesting is that semiconductor stocks and others have had really good runs so far in 2023. A lot of them are overbought, right? Overextended to the upside. We may be seeing some bearish momentum divergences, some of those leadership names. If we see that and we see bullish divergences from beaten down areas like energy, are we getting a mean reversion where the leading stocks start to rotate lower and beaten down sectors like energy, maybe materials and industrials start to rotate higher? This is one of the leading indicators that tell you that might be coming up. What's interesting is it's not just on the chart of the OIH. Two of the biggest holdings in the OIH together make about 35% probably of the ETF are Schlumberger, SLB, and Halliburton, HAL. If you look at each of these charts individually, you can see that there are a lot of similarities to the Oil Services ETF. Number one, they're in clear downtrends. They've made lower lows and lower highs. Schlumberger, for example, SLB is below its 200-day moving average. It's actually below both of these moving averages. I'm very much drawn to mid-2022, and it's interesting seasonally. We're almost at the same part of the year. We saw a brief break below the 200-day moving average, kind of chopped around there for a couple months before rotating back higher. We're sort of in that same sweet spot of testing the 200-day and for now remaining below. Note this bullish momentum divergence though. Lower lows March into May in terms of price, higher lows in momentum. You're going to see the same thing on the chart of Halliburton. Again, also below its 200-day moving average, also below the 50-day, but showing that same bullish momentum divergence. What's interesting to me is with this particular ETF, and it's not on all of them, the XLE is not showing this particular pattern. Not all energy stocks trade exactly the same, but you're seeing a lot of them that have been in a downtrend so far after January, February of 2023, making lower lows and lower highs, and now all starting to have more constructive momentum pictures, particularly with this bullish divergence. The way we would confirm that a bottom is in and that a mean reversion trade is certainly engaged is if we do check some of those boxes that I mentioned earlier. Let's stop making lower lows and make a higher low. Instead of being below moving average resistance, let's break above and have the moving averages serve as support. Let's see if the relative strength, relative performance can improve and we can start to outperform the benchmark. And let's see if the momentum, RSI, can get above 50 and ideally above 60. If those things happen, that may be the confirmation you need to know to confirm that the trend is now reversing from down to up. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. I'll talk to you again soon.